Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. So today, we are doing a deep dive into three, well, I'd call them colossal shifts happening globally right now. And when you put them together, they signal a really profound change in how we have to think about investing.
Oh, you would do.
We're trying to move past that idea that, a rising tide from a central bank is just going to lift every single asset.
Exactly. That era is fading. For the last, decade?
Hmm.
Market success was often just tied to guessing what the central banks would do. That was the whole beta trade.
Right.
But what recent analysis confirms is that we're moving into a phase where that's just not enough. The next phase is about finding specific companies, specific assets with real cash flow and strong performance. It's about finding the alpha.
And if you're not looking for that alpha, you're going to get left behind.
You're just swimming against the current.
Okay, so let's unpack this. Let's start with the heart of it all, the Federal Reserve. The big headline was that the Fed delivered its third straight interest rate cut. They lowered the target range to 3.5% to 3.75%.
Right, which sounds like simple easing.
It sounds simple, but the data we're looking at suggests this was maybe one of the most complex and contested decisions we've seen from them in years.
Oh, absolutely. What's fascinating here is just the sheer amount of internal disagreement. This wasn't a consensus decision at all.
Not a unified front.
Not even close. We saw 3 dissents.
3? Wow.
Which, for the Fed, is a huge signal of uncertainty about where policy is headed. You had 2 governors, that's Oglesby and Jay Schmidt, who voted against the cut completely.
Okay, so why? What was their logic for just wanting to hold steady?
Well, they argued that the economy is still running too hot. Consumer spending is strong, and inflation is proving to be pretty sticky, especially in the service sectors.
So they're worried about reigniting it.
Precisely. They saw the cut as premature, something that would just force the Fed to slam on the brakes even harder down the road.
Okay, so you have 2 dissenters saying the cut was too easy, but then the third one, Director S. Myron, wanted the exact opposite.
The complete opposite. Myron wanted a huge 50 basis point cut.
That's a massive gap in opinion.
It's a chasm. Myron's camp is looking squarely at the jobs market. They're worried about employment cooling off and think the Fed needs to get ahead of it now to avoid causing unnecessary pain later.
So the takeaway is that leadership has fundamentally different reads on the economy.
100%. They can't agree on its temperature or its trajectory.
And here's where it gets really interesting, because despite cutting rates, the Fed then dramatically upgraded its long-term growth forecasts.
Yes.
They took the 2026 U.S. GDP growth forecast from 1.8% all the way up to 2.3%.
And that upgrade is the key to this whole thing. It is essentially a no-landing declaration.
Explain that analogy.
Well, think of the economy like a plane. Everyone was expecting the pilot to either land it gently, a soft landing, or, crash into a recession.
Right.
Instead, the pilot just got on the intercom and announced they're staying airborne at a higher cruising speed, thanks to things like the AI boom and strong consumer balance sheets.
So the economy's healthy, but they cut rates anyway. Why?
And that's what makes the cut itself hawkish. Because the economy is so robust, the Fed doesn't feel the need to slash rates to save it. If you look at their dot plot, their own projections,
Their map for the future,
it suggests only one single rate cut in 2026. The market was expecting far more. So they gave a little something now, but signaled the party's not going to last.
But the sources highlight that the real story wasn't the cut or the forecast. It was something called the Reserve Management Purchase, or RMP.
Yes, the RMP.
So what is that, and why did Wall Street basically treat it as the biggest news of the day?
Okay, so the RMP is a mechanism where the Fed will start buying $40 billion a month in short-term Treasury bills, T-bills.
Okay.
And they frame this as a purely technical measure, just to keep funding markets stable, balance sheet management.
Just plumbing, basically.
That's the official line. But here, interpretation is everything. Remember quantitative tightening, or QT. That was the Fed shrinking its balance sheet, pulling cash out of the system.
Right.
While buying back $40 billion a month is the opposite. It's injecting cash back in. Wall Street immediately saw this as the end of QT and the beginning of what they're calling stealth QE.
Stealth quantitative easing. Yeah, injecting $40 billion a month doesn't sound very technical.
That's a huge liquidity event, and the market's reaction proved it. The Dow jumped over 1%, the dollar dropped, And even things like Bitcoin held that $90,000 line because of this expectation for more cash in the system.
So the big takeaway here is that we're shifting. We're moving from that aggressive early easing cycle into a much more cautious, well, late easing phase.
That's the perfect way to put it. The beta trade, riding the Fed's wave, is receding. It's time to find companies that can generate their own alpha.
And that idea, moving away from policy dependence, actually leads us perfectly into our second major shift. Because if the U.S. is stable but competitive, you have to look globally.
Exactly, and that's where Mexico comes in. We're shifting from monetary policy to geopolitical strategy.
What's the change?
Mexico's Congress just passed a law that significantly raises tariffs. We're talking up to a 50% maximum, often around 35%, on a huge range of goods.
And who is that targeting?
Crucially, it only applies to countries that do not have a free trade agreement, an FTA, with Mexico.
So that means China.
The primary target is definitely China, yes. But the data shows the list is much broader. It also explicitly names other manufacturing powerhouses like India, South Korea, Thailand, and Indonesia.
And the sectors are broad too, right? Textiles, steel, auto parts.
It's a wide net. Footwear, appliances, plastics. It touches almost every part of the North American supply chain.
So what's the real goal here? Is Mexico suddenly just becoming protectionist, or is there a bigger play?
The sources are pretty clear it's the latter. The main motivation is strategic alignment with the U.S. ahead of the huge 2026 USMCA review.
The U.S.-Mexico-Canada agreement.
Exactly. This is all about creating negotiating leverage with Washington.
But wait, isn't that a huge gamble? They're risking a trade fight with China that could hurt their own manufacturers who need those Chinese parts.
It's very high stakes. But from Mexico's point of view, the USMCA renewal is everything. They're choosing their team. Think of it like this. Mexico's doing some preemptive house cleaning.
Okay.
They're making their home more appealing to their most important neighbor, the U.S., before they sit down to negotiate renewing their shared property agreement. It gives them a powerful chip to play.
And this creates what investors are calling the nearshoring premium. What does that mean for companies on the ground?
It means that if your company is already set up in manufacturing in Mexico or another FTA partner, your assets just became a lot more valuable. You now have a major cost advantage over any competitor trying to import from Asia.
So it's a huge incentive to move production there.
A massive one. It's a direct driver of fundamental performance. Pure alpha.
But it can't be all good news. The data we have highlights some major risks. The first one is inflation inside Mexico itself.
That's the critical bottleneck. Mexican factories still depend heavily on components and raw materials from China. Higher tariffs on those inputs mean higher costs.
So they'll pass those costs on.
Either that or their margins get squeezed. And restructuring those supply chains, that takes years.
Okay, risk number 2, Chinese retaliation.
It's not a hypothetical. Beijing has already called the move protectionist. They could easily hit back with their own trade restrictions or, just delay big investments they had planned in Mexico.
And the third risk is more subtle, the indirect impact on other countries.
Yes, because the law hits any non-FTA nation. A country like South Korea might not be the main target, but some of their key component exports could suddenly face these huge tariffs, forcing them to rethink their entire supply chain too.
So the lesson for an investor is to get really granular. You have to ask, is your company manufacturing in Mexico and benefiting, or is it just importing to Mexico and now facing a huge cost problem?
The distinction is everything.
Okay, let's pivot now from trade to technology, because our third major shift is happening right on the factory floor.
The rise of the machines.
Well, specifically, humanoid robots. A TrendForce analysis is predicting that 2026 will be the commercial inflection point for them.
It's a huge forecast. We're talking about global shipments potentially topping 50,000 units that year. That's over 700% annual growth.
So this isn't just about cool demos anymore.
No, this is about moving out of the lab and into the real world. And what's really changed, according to the sources, is the metric for success.
It's not just about the tech specs.
Not at all. It's about scenario-based application and AI adaptivity. The focus has shifted to total cost of ownership, the TCO.
Meaning, does this robot actually save a company like BMW money on their assembly line? Or is it just a fancy photo op?
Exactly. The investment decision is now strictly about ROI.
And the data shows a really interesting strategic split in how the global powers are approaching this. You have the U.S. on one side.
And the U.S. is focusing intensely on data and software. Their approach is all about who can train the physical AI, the fastest and most reliably.
Deep learning for the physical world.
Right. And on the other side, you have China. Their strategy is all about policy and scale.
What does that look like?
It's classic Beijing. Use massive government subsidies to push for mass adoption, scale up production, and just flood the market to drive down component costs. Turn high-tech into a commodity.
So if price wars are basically inevitable, that raises a really important question for investors. Where is the actual sustainable value?
Well, according to analysis from groups like McKinsey, the highest margins in this early phase will not go to the companies making the finished robots, the OEMs.
They're the ones who get hurt in a price war, so the smart money isn't on the robot itself.
Not exclusively. The alpha is in what you could call the bottleneck layer, the picks and shovels of physical AI.
Okay, break that down for us. What's the first bottleneck?
Key components, we're talking advanced actuators, sensors, and high-precision parts. These are the joints and the nerves of the robot. They're incredibly complex and very hard to commoditize quickly.
And the second would be the brains.
Correct. AI computing and software. This is the accelerator chips, the edge inference systems that let the robot think for itself on the factory floor, and the specialized operating software. That's the IP that's hard to copy.
Okay, so components and software. What's the third bottleneck?
The infrastructure. You can't run these things safely on standard Wi-Fi. They need dedicated, low-latency private 5G networks and edge computing systems right there in the factory. It's a non-negotiable part of deployment.
So the lesson is to invest in the enabling technology, not just the final product.
A high-risk, high-reward space, but yes, that's where the sustainable value is likely to be.
So if we pull all three of these stories together, the cautious Fed, the relining trade routes, and the rise of commercial AI hardware, there's one big message that seems exceptionally clear.
It's the end of an era. It's the formal transition away from pure policy dependency. Success isn't about predicting the next rate cut anymore. It's about disciplined asset selection and understanding where these new technological and geopolitical bottlenecks are creating real value.
So the data is telling investors to stop asking that passive question, what will the Fed do to boost the market?
Right.
And start asking the active strategic question. In this new environment, which specific assets can actually stand on their own and create real-world value?
That is the question for the next decade.
Which brings us to a final thought. We are seeing the birth of the physical AI economy. Integrating AI into hardware like humanoids requires a massive, constant flow of real-time data, and a lot of that is tied to worker safety. So will the future of manufacturing be determined by who builds the best hardware, or by who owns the most secure, the fastest, and the best regulated data streams? Don't forget to subscribe and hit that like button.